This video analyzes the impact of India's May 2026 windfall tax revisions on fuel exports, focusing on how major oil companies like Reliance, Nayara, and MRPL are set to benefit. The big news is that the Indian government has reduced the extra tax, known as the windfall tax, on fuel exports. This reduction comes as global market prices begin to cool down. The update includes lower export taxes on jet fuel and diesel, making it cheaper for Indian refineries to sell products internationally. Additionally, a new small tax of 3 Indian rupees per liter has been added to petrol exports to ensure domestic supply. The revised tax rates show a significant reduction in taxes for jet fuel and diesel exports, making them 51% and 28% lower, respectively. Petrol or gasoline now has a new tax of 3 Indian rupees per liter. The tax was reduced because global benchmark prices in Singapore dropped significantly. Jet fuel and diesel prices averaged around $158 per barrel, while petrol was at $130.99 per barrel. Reliance Industries, operating the world's largest refinery, is a major beneficiary. The lower taxes on diesel and jet fuel mean better profit margins, improved export competitiveness, and higher earnings per liter exported. Nayara Energy, a large private fuel player focused on international sales, also receives a boost. With the jet fuel tax cut by more than half, Nayara can now compete more effectively in the recovering global aviation fuel market. Mangalore Refinery, MRPL, a key state-owned exporter, benefits through higher revenue as lower tax expenses allow the company to retain more of the global selling price as profit, leading to a better market outlook. The new 3 Indian rupees per liter tax on petrol exports was imposed because global petrol prices rose in May. This measure aims to discourage excessive exports, ensure sufficient domestic availability, and curb domestic fuel inflation. This dynamic policy builds trust with companies, offers better margins for refineries like RIL and Nayara, and ensures energy security by balancing exports with domestic needs. It also brings positive stock market sentiment to the oil and gas sector. The fuel export taxes are continuously reviewed, not set and forgotten. The Finance Ministry monitors global prices daily. Tax rates are analyzed and revised every 2 weeks, with changes published immediately on the CBIC website. Thank you for following this analysis. We hope this video provided clear insight into the impact of India's fuel export tax revision.